Welcome to the PIWORLD webinar on the 9th of April 2020. I'm Tamsin Freeman and I am your host for today. And we've got Stephen English joining us to discuss his investing strategy in these COVID times. Stephen's webinar title is Plague on All Our Houses, How to Repair Some of the Damage. Stephen, thanks so much for joining us today. For those who don't know you, give us a short overview of your background.
Thanks for having me, Tamsin, inviting me as always, and thanks for everyone for tuning in, making time out there, busy days. I've been at Blankstone Singleton since 2002, and since 2010 have been responsible for managing our AIM IHT proposition. So I work within the research department at Blankstone Singleton, who are a investment manager, stockbrokers traditionally, private client management mainly, and some larger institutions.
So, give us your thought on the current markets. Did you see it coming?
I'd love to meet someone who saw it coming. It was a classic 1-2 punch combination from almost two Mike Tysons, a kidney blow, and then an uppercut with the oil price collapse on top of COVID. So absolutely didn't see it coming. A pandemic has been a live option every year for the last 100 years. What I did see coming, in fairness, has been a little bit too much frivolity, some frothiness. You look at what's been going on with VCs and the WeWork debacle, and risk appetite generally was a little bit too hot. So we were increasingly moving to defence for the last 18 months, positioning the portfolio that way. In resilient businesses, I never for one moment thought a pandemic would shut the economy down, but thankfully we had some businesses that are actually prospering, in likes of Tristel, make high-level disinfectant for the NHS and also globally. Acrol, toilet roll manufacturers. I never knew toilet roll would be as coveted as gold, but thankfully they were in there. That was the ultimate doomsday goods. And we've had smart metering systems, which did a fantastic deal, and they get rents effectively backed by government, got a huge net cash position and pledged to a very deliverable dividend yield of 4%. So we have been altering the portfolio. We had Begbie's Trainer in there, and more recently FRP Advisory. So they're both, you would suspect, their outlooks have improved markedly given their insolvency focus. Saying that, though, you can't batten down the hatches too much. You have to have some upside and more blue sky exposure and cyclical exposure. But I would say we were defence. Over the crash as it's happened, we've probably gone from defence now more towards a neutral position. Still think it's a little bit early for full-on attack. But when you're in the kind of maelstrom and when it's all around losing your heads, I did find that it's better to do absolutely nothing. And that's a pretty sound investment strategy, actually, to do nothing. And don't just do something, stand there, to butcher the aphorism. If you are skittish, you only had really 1 or 2 days to sell out of this completely to dodge the downdraft. But you would have done that probably a dozen times since 2009 and been jumping at shadows. So we've been fully invested. We have to be because of the IHT strategy. But I did send a note out to clients a couple of weeks ago when it was near its nadirs and basically saying to sell now, it's really to bet against human ingenuity. And that's been a pretty bad bet to take historically. And the more optimistic you sound, the less intelligent you sound, because pessimism can sound very intelligent when things are very febrile and nervous. But absolutely, look at the decades that have rolled by, never bet against human ingenuity.
Very wise. So before I go on and ask you whether you think it's hit the bottom, let's ask everyone on the webinar whether they think it's hit the bottom. And on your screen now, you should see a poll. And if you could say yes or no.
Okay. That'll be interesting to see.
Yeah, absolutely. We're just waiting for those to come in. Do you want to go on and give your views while we're waiting for those figures to come in?
Sure. It's a question investors regularly phone in. Have we hit the bottom? Is this a great time to invest? What we say is don't obsess over trying to pick the bottom. I think you're keeping the wrong score if that's how you're going about things. Mentally, it's actually better almost to expect the share price to fall further after you've bought it. And that may sound odd, but you can phase into a market. It doesn't have to be all in or all out. No bell will be rung when the market bottom has been put in place, and it'll take weeks, if not months, for us to realise that that actually was the bottom anyway in the first place. And the market, it's an ephemeral beast at the best of times. We're more interested in the actual individual stocks rather than the market itself. But unfortunately, when times are difficult and it's horrendous to invest, certainly from a value perspective of value investors, the most upside will come from those investments that have the ick factor, or which feel grossly uncomfortable when you are going into them. Me personally, I would be highly surprised if we don't retest the lows that we've seen a couple of weeks ago. Howard Marks has got a great memo just out called Calibrating, with a statistic in the 15 bear markets we've had since 1950. On only one occasion did we not retest the major low for that move. So 15 isn't a great sample size, admittedly, but certainly that historical record would point towards a retest of the lows at some point in the future.
Interesting. Now let's just break and see the results from this poll. So there you go. Can you see that on your screen?
I can indeed. That's quite resounding.
Yeah, it is indeed.
Wow. Okay. We'll go ahead. Probably largely concur with that one. I don't know if that's a good thing or not, but thank you for voting.
So 68% no and 32% yes about whether we've hit the bottom. So give us your thoughts, Stephen.
It's there's a good slide John Authors pointed to in his Bloomberg points of return column, and he's compared the current sell-off, which is the black line, to the three major crashes, if you want to call them that we've had historically: 1929, 2008, and 1987, and they're all rebased to their peaks, and the horizontal axis is the days thereafter. So on this basis, and I'm not a massive fan for overfitting these types of charts, but on the previous crashes, and this looks, well, it isn't more like a crash than a correction. On all the other occasions from this point, we were lower over the next 2 weeks. So this is only very, very short term. But something has gone slightly awry in markets, and I do stare at charts for an inordinate amount of time. Call me a closet technician, but we've got a chart that shows the FTSE All World Index and how that's broken the trend line. That's a pretty entrenched trend, I'm sure you'd agree, put in place since 2009. So technicians would call that a damaged trend. It's plummeted right through the trend line, but you may be able to just make out the bounce that we've had recently. This is the kind of wobbly ruler school of technicians. Nevertheless, what normally happens when a key support level gets breached, you'll get an intermittent rally that will retest that previous support level. So that support now becomes resistance, a resistance level. To get back up to there, this is the FTSE All World, as I say, that would be a 20% bounce from the current or most recent low. And that is actually the average bear market bounce that we have seen in all the bear markets since 1920. The average and median has been around 20 to 22% bounce. So perhaps it's not surprising that we've seen this come through at the moment and people are now calling the bottom. I think it'll be fascinating to see whether it can make further progress from these levels or if it starts to roll over. And I think when you're talking about market bottoms, it's probably better to look at it in different phases. Bear markets transition as you go along. The first phase, we went through that kind of mass liquidation stage. Correlation goes to one. The baby gets thrown out with the bathwater. It's a case of sell what you could, not maybe what you should. Then phase two, which I think we're going through rapidly, and everything's going through fast forward in this crash. The crash was fast forward, and maybe the recoveries in the various stages, a bit like grief, are going through fast forward as well. But this stage now I see as much more discerning. What I prefer, rather than trying to call the market bottom, it's wait for the companies to update us with the most informative, contemporary information and not to act preemptively. I'm more interested if individual companies are offering value because stocks can actually rise in a bear market, and it's important to remember that, and they can actually fall in a bull market. So why the stock market does in between now the next few years is kind of secondary to your portfolio of stocks. And everyone's going to have a different investment philosophy, and this is a very personal thing. So this is my point of view, which is framed also by the inheritance tax consideration. But everyone should have that process, because if you don't have a process, then your execution won't follow through on the back end of it. But talking about stocks, there are a number of stocks I think, or would be surprised if we retest those lows. And I've got 3 coming up now that show that exact situation, where I do think that we've seen the lows, but may be wrong. If we retest the lows, then we'll simply buy more of them if you've got client money coming in. I would call these the high quality stocks. Strix Group is in the blue, Traxys is in the red, and Oxford Metrics in the green. So despite the quality of these stocks, you can see they generally all correlated and sold off in unison. And when there was peak fear, that's when the bargains were to be had, and we were trying to pick some up and did pick some up. Not at the bottom, and I don't obsess over that, as I say, but we certainly moved to load up on more of those stocks. And as I say, if they fall back again, absolutely fine. That'll present another opportunity in that cohort of stocks. There are certain things or metrics you can look for if you're trying to time the bottom. High yield bonds, I would say, tend to lead us out of this one. Value, particularly small cap value, also tends to lead us out. So when they start outperforming, and that's exactly what happened actually. If you did an amalgam of World War One and the Spanish flu, the last pandemic we had, small cap value was the place to be, point to point. Yes, they fell more, but they recovered much, much more than any other factor in the market. So over the cycle, that's where you would have made the most money. I think it's important as well to remember the stock market isn't the economy and vice versa. Markets can and will rally in the recession. I use the phrase that the stock market acts to confound as many people for as much of the time as possible. And that's exactly what it's doing at the moment. There's a key difference between uncertainty and risk. Risk you can quantify, you can put odds on it as the bookmakers do, but uncertainty you can't really quantify, and that's where markets really have difficulty. But all you need to see the bottom in place is not light at the end of the tunnel, it's just ever so slightly less dark, and that's where you'll start to see things move up. And when we were at March 09, no one rang the bell. The news flow got worse after March 09, but that was the actual subsequent bottom in the stock market. And I think I'd finish off on one thing. When you're trying to get your head around how deep is the correction going to be, and it is tied into ultimately the 3 Ds, I call it, of a recession. The 3 Ds being the depth. So how deep is the economic recession? How diffused is it? So how many people does it affect? And then finally, the key one is the duration of the recession. And that's the key unknown at the moment. And we got the slide here from Josh Brown, who's a fantastic, prolific writer at Reformed Broker. And see the outlier there in terms of the longest recession from this data set going back to the 1920s. The longest one recession-wise was 45 months, and that caused the biggest sell-off, which is the vertical axis in the S&P, which was a fairly horrendous 80+% fall in stock market values. So there is a correlation between the length of a recession and how much damage is done to equities. Trying to pin the tail on the donkey now on how long this one is going to last. It is unlike anything certainly I've ever seen, or pretty much everyone else has ever seen. We've effectively switched the economy off, which is all horrendous and hugely disruptive. The offset to that is you can effectively switch it back on again when you allow people back to work. So I would say don't obsess on just the recession aspect. Don't just look at the negative side. No man is an island. Governments haven't been standing back on this one. They have poured everything at it, both fiscally and monetarily. And you've got to be cognizant of the extent of the stimulus that we've actually seen. Where that stimulus ends up as a percent of GDP, who knows? It could be 10, 15, 20, 25% of GDP. But that was always going to happen. And to an extent, that had to underpin asset values. And that's the great difficulty for investors. And I think that's why you're seeing the gyrations in the stock market that are so volatile at the moment. There's an interplay daily going on between those fear of losing money and fear of missing out. And when there's this much liquidity sloshing around both the monetary system, but also the real world in terms of the fiscal system, it does make it very hard to be totally out of the market. And I think, as I say, to be totally in or totally out is just too stark. You can be a little bit in, a little bit out, or more so. I think that makes it easier psychologically to get your head around it. Not many people thought March 09 was the bottom. Loads of people missed out. They said they'll get involved in the next correction. The corrections that came were never big enough for them to get involved, and then they missed the boat. It's why, to a lot of people, the 2009 to current rally was the most hated bull market in history, because no one really bought into it, and it was a bit of a head fake.
So let's just check in with people's sentiment today and say, if you've got 100,000 to invest today in cash, what percentage would you invest? And there on the screen you can say 0 to 20, 20 to 40%, 40 to 60%, 60 to 80%, or 80 to 100%. And while you're answering that, Stephen, what's your strategy?
This is a very personal thing, and it's really at the margin, so that we haven't been doing wholesale change. And it's got to be personal, because if you abandon it when you make first contact with the enemy and realize the enemy is yourself, then it's no good at all. So I would caveat that you've got to be comfortable in your own skin. So it may not be for everyone, but for us, I think it's important not to try and figure out how to win the last war. And after the damage has been done to the portfolios, then try and buy resilient companies, and selling off or switching out of companies with a certain sense of bounce back ability, if you want to call it that. You do need a balance to the portfolio. As I say, we were already defensive, so actually we've been going the other way and becoming more neutral. So actually maybe taking a little bit more risk on, because prices have fallen to a level where we thought they discounted a lot of bad news. I would also caution, don't buy stocks that are kind of virus stocks, the likes of Zoom, which has been found to be pretty wanting on its security, with hackers getting in and causing all sorts of disruption. It's not very safe for children to be using at all. And one of their shareholders is actually suing them now because of that. Or Peloton, this expensive contraption with some kind of sweat mat underneath it. A quarter or 2 quarters of good trading is utterly irrelevant to the long-term outcome of that company. So don't get head faked or sucked into companies that are doing very, very well. They'll burn brightly, but very quickly. That they can be a trap for your money. They generally sell off as fast as they went up in price. Only look for companies if there's a lasting legacy from this pandemic. Perhaps they're going through super normal trading and they can use that to repair a balance sheet that was a little bit weak going into it. But my strategy, I put it into 3 buckets. Buy what to buy now, what to buy later, and what to buy never. It sounds a bit like Snog, Marry and Avoid, that TV program. So now, later, or never. The quickest turners in an initial phase of bear market are generally the most bombed out, and they're really for traders, and they generally come with the highest risk. They're going from pricing a 90% insolvency to maybe 60%, which can be good for a 50% share price move. So we don't really look to go to them. What we look for instead are those that are high quality. Sooner or later, the business will switch back on. Some of them, the revenues haven't gone down that much at all. And it is important for the ones that you're going to buy now, you've got to be confident that they are forecastable. Their earnings and their earnings power are undimmed by this pandemic. Because if their earnings power over the long term is undiminished, then the sell-off has presented you with a very attractive entry point. Traxis Group, I would throw into that. Effectively, the rail network has been nationalised by the government for the time being. That's not too bad at all for the train operators, because they're getting a management fee And so effectively, they're all now profitable, probably for the first time in a long time, and their costs are getting underwritten by the government as well, and Traxys sells software into them. And if anything, they're seeing accelerated order flow while this current structure is in place. So they're ones to look for, and it's crucial. Avoid companies that are going to build up a very large debt burden between now and when the economy opens as well. They're going to be encumbered by a big debt load that they have to burn off at some point. So they're the ones I would buy now. You want to call it a high quality. The ones that I buy later are ones where the visibility isn't there for the moment. It's a bit like dynamite fishing. It does take time for issues to rise to the surface. Will they need a big working capital injection that they can't fund at the moment? Will they need recapitalizations that we've seen in 2009? Some of them likely will. If they were already seeing revenues fall going into the virus, well, the virus is not going to do anything for those business models, so move on. But there are going to be some great recovery stories coming into the second half of the year. If they have the wrong capital structure going into it and need to refinance, that's fine, we'll look at it then. But you don't need to rush with those types. So you can do the ones now, the ones later, and then ones that you'll just avoid, which are the deep value traps, and perhaps they're not going to be able to raise the money to survive. And when it comes to raising money, you're seeing daily placings now. Fund managers will favour their existing portfolio positions if they need money. If there's cash, that's fine. If they run out of cash, that means they're going to have to sell other positions later on if they want to fund placings from their others. And when it comes to the corporates, self-interest dictates that you either want to be first or last to raise. You don't want to be in the middle when cash has become a scarce resource. So at the moment, in the initial stages, it's fairly abundant. So you want to go early as a company, and that's what you would tell them. Well, you want to be last when the economic recovery is kicked in and we've got much better visibility and you're happy to take more cyclical exposure. Then that's how I play it. If someone wants to make the most money, there'd be a different strategy, and that would simply, you buy the cheapest company, as many as possible, because some will go bust. But the ones that don't go bust will rally very, very hard from current levels, where I think that's too speculative for me. So to simplify the strategy, if it's high quality business, forecastable earnings, and it's going to be unscathed, buy it because the price is created. If it's a low quality company, very cheap, don't buy it because the price is created. You're far better waiting for that share price to go through its turmoil, wait for it to turn, wait for it to go above its 200-day moving average. Ideally, you want an inline trading update, or if not, earnings upgrades coming through as well. But you've got that surety then that they are through the worst and there's tremendous upside potential to come in recovery situations. There's a lot of cheap stocks now at the moment that will be value traps, and some won't make it. Some that are listed today simply won't make it, and avoid them. You know, a DVD, a straight-to-movie DVD that's in the garage forecourt for £1, and now it's 50p. It's still pretty terrible value. Maybe I need to update my analogy on that one because I don't think anyone uses DVDs anymore.
Interesting. Now we've got the results back of the poll, which is 27% would invest 0 to 20%, 19% 20 to 40%, 25% 40 to 60%, 20% 60 to 80%, and just 9% would invest 80 to 100%. So that's interesting.
Wow. Very interesting. It's a lot more diffused than I thought it would be, given the first poll, when over 2/3 of people felt we hadn't yet reached the bottom. I thought the 0 to 20 and 20 to 40 would be the majority there, 45. Interesting. Yeah. It takes two to make a market, as they say.
Absolutely. So has the business case changed for any of the companies that you hold?
It has undoubtedly. The world's going to be a very different place. Shoezone was net cash going into this one. It's taken a lot of pain already. It's going to have to raise a large loan from its banks. It's going to need the forgiveness from some of its landlords to defer rents for the time being or go through rent periods. But I absolutely think it will get the loan, especially with the government guarantee backing 80% of these loans now. We won't have a dividend for a period, but I would class this very much as a survivor. I think there was a burgeoning growth story going on with their big box stores, which are rolling out, which sell higher end labels than their traditional high street secondary located stores, so likes of Clarks and Skechers and Wranglers. And I did notice that Clarks is also now in a world of pain. Perhaps it's got too many stores on expensive real retail parks that maybe you could look to Shoe Zone to take that off them instead. So it has changed. It's going to be a smaller business coming out of it, but I do back the founders there. Over 50% of the shares are held by the founding family, and they have been through recessions in the past, albeit not one where almost all of your revenue's gone to zero. One where we did sell, K3 Business Technology. We were a long-suffering shareholder in this one. They were trying to do the right thing by increasing their own intellectual property. They did a big reselling part of the business as well, which wasn't terribly high quality. Progress was glacial, to be kind. They had a habit of not generating terribly much cash, but say I thought the situation would improve. Their focus on end markets is retailers, and this really was the straw that broke the camel's back. And when you're looking at other opportunities where you've got a far higher conviction, it becomes almost an easy switch sell then where the conviction's gone on here. And software companies are only as strong as their end clients. And I just think it's going to be very, very difficult for them now. So we did have to move on from K3 Business Technology. And another one sold just this week is one that's actually held up very well. It outperformed the falling market. It still fell in absolute terms, but it held up very well. That was Alliance Pharma. They do have a penchant for debt and rolling up through acquisitions and not overly concerned with going 2 times net debt EBITDA, which always affected the stock market rating. But I've just got concerns over ongoing capital allocation there. I do think they will recover more from the current level, so I'm not selling them because I think the share price is going to fall. I just see better risk-reward opportunities elsewhere. So that's another one where we've just sold this week and we've already redeployed the capital.
And for you, was liquidity an issue? Because getting out is sometimes difficult, particularly when you've got a large volume.
It is. I was talking to market makers a lot during the frenzied stages of the sell-off. And week number 1, when the proverbial was hitting the fan, it was pretty much all retail-driven flow. And I think what greatly exacerbated the sell-off this time, and I was staring at the screens, and I was there in 08, and this was manifestly more challenging and more severe than anything in 08. It was the speed of the collapses of nearly all equities, and collapse a lot of them did, at least in the short term. You've got to remember, because the market makers like ourselves were having to scramble for laptops and trying to work remotely, that takes a few days, and best will in the world, the systems, at least initially, aren't going to be anywhere near the same quality as the systems in their office, and trying to have total visibility over all your books and what positions you're carrying over. So there was a void that the retail traders sold into. I think we've got a lot of time on our hands now as well. Napoleon thought we were a nation of shopkeepers, but at the moment we're a nation of day traders. The volume is very bitty. Speaking to the market makers, it's 25,000 shares, 10,000, 30, 50,000 shares, rather than big lumps coming down the track. So if you try to buy in any size at those giveaway prices, you would have had great difficulty doing so. And in any size, I might be even only talking about 50,000 or 100,000 pounds worth. The advertised prices sometimes are reflective of where you can do big volume, but in a crash and in phase 1 of a crash, they're absolutely not reflective at all of any sort of size that you can buy in. So you could argue they're a little bit fictitious in those prices. But that's exactly what happens, though, in those initial stages. And there was one example I'm going to show, and this was an IPO that we went for. It was the only IPO that got away in March. This is FRP Advisory. They were the insolvency practitioners for Patisserie Valerie, and we didn't look too clever on this one initially. The black line is the share price and the orange is the FTSE All Share. So thankfully it's turned out okay, at least in the short term. We're up 11% and the AIM market's down 16%. So very strong outperformance. But at one point, FRP had sold off 10% from its IPO price. And that's despite its outlook getting the best really since 2009, if not the early 90s. So they've just been awarded the Carluccio's administration. They're rumoured to be winning the Debenhams administration shortly. So they're kind of a bigger version of Begbie's Trainer, and they're actually picking up a lot of business that the Big Four traditionally used to do, but they're now a lot more conflicted than they used to be in the past. So they've got great relationships and great reputation that they're building there. But that just shows you, despite its outlook improving, it actually got sold down. And this is what I was speaking about, where the baby gets thrown out with the bathwater. And they're brilliant. They're what you should look for, those technical driven sell-offs, not fundamental. Same thing happened to Begbie's Trainer, the other insolvency practitioner, bumbling along at 90 pence, and then wallop got down to 60p just because the market crashed. So the market's crashing because the economic outlook is deteriorating at a rate of knots. That's fine, but they both can't be right. So Begbie's would have had to rise, and it has. So from its bottom on the 23rd of March, Begbie's is already up 53%. So markets aren't that efficient, especially when you've got a frenzy in a bear market, and in fact, they become wholly irrational. So that's an opportunity to take advantage of that liquidity. I don't think you'll see that again now. I think it'll be much slower burn, the sell-offs that we see between now and the coming months. But it was next to impossible to buy in any sort of size at the beaten down prices.
So who do you think will be the other winners?
Last man standing is a trade that didn't really work well in 2009, and I think that was largely because of the bank's forbearance. So these are ones with strong balance sheets, better business model, better culture, but a strong balance sheet in isolation isn't enough if everyone else in the sector has got an okay balance sheet or access to liquidity. It's a relative game, and so much of investment is all about relative. So last man standing, definitely, if their peers went into this with suboptimal balance sheets, if you want to call it like that. I'm surprised at how many companies I'm talking to are thinking about taking advantage of the other side of this. And on the one hand, it's exactly what they should be doing. And investors are very, very happy to back them. And that's good where it makes sense. If we've got a 90s recession rather than an 08, 09, where you had capacity taken out the market much more in the 90s, that's when you get a lot more bang for your buck from a last man standing strategy. Note, though, paradoxically, the share price will fall in unison with its weaker brethren, at least initially, because the market's not too discerning when a sector's going down, but it will decouple at some point when the market switches on to the fact that these are going to be the last man standing and reap the benefits. And as they come through this, they're going to have a bigger business than they would have had going into the pandemic. So definitely look out for that one. Another one is Strix Group. I found out today Strix is Latin for screeching owl, which is a new one on me. But this is a fantastic company. Owned it for a while, going along at £2, then it gets sold down to £1.20. But I think these will be a winner, maybe not because of the pandemic, or it's just to flag them, because sometimes a great story can develop below the radar. And there's a school of thought that you are not a great small cap company unless you transition to be a large cap company. And I've got some sympathy for that view. I think you can be a very, very good small cap and always stay a small company, and you can be a very, very good investment. But to be truly great, I think you need to hit the heights and have much bigger markets. And Strix, if you pull up the share price, show you how that performed. These are the leaders in global kettle controls. So if you pick up your kettle, 7 times out of 10, you will see Strix Group underneath. They dominate their markets, and it's a great backstory where their technology came from. It was actually World War II flying suits. But even though they're a small company based in the Isle of Man, their products are used by 20% of the world's population 1 billion times a day. Very, very good at what they do, and have now started to move into adjacencies. And this is why I think they're going from a good story to a great story. As good as the kettle control market was, it had a relatively small total addressable market, £160 million. They were owned by private equity who are running them for cash. Since they've been freed up on the stock market, they have invested a lot more in their new product development. They also do the innards of the Tommy Tippy machine, and they've just signed the Asian #1 equivalent to do similar. So they do have expertise and experience already in appliances. So they're moving much more now into adjacent markets in water filtration, in hot water on demand. You'll see their kettles, they sell to the brands, so like the Tefal and Philips. You'll see it's called the Duality. So it's a normal kettle and it will just boil 1 cup of water rather than the whole kettle, because we apparently waste 300 million pounds of electricity every year by boiling too much water. That's just one of 14 products that are going to get released over the coming 12 months. So the total addressable market is now exploding to over £3 billion from £160 million. So this is very, very high quality. This is the one that you would try and back the truck up and buy as much of in a technical driven seller. The chart underneath, the bottom chart, is actually the share price plotted relative to the FTSE AIM market. So even though the share price fell, it actually fell by less. So that's why it's actually rising. So it's outperformed very handily the FTSE AIM market. And I think that's testament to its prospects. And it's a fantastic manager who's in charge of that business. So they're not going to be encumbered by growing debt because the business is shut. If anything, people are using the kettles more, so they don't have to burn off that debt position. And they do generate very, very strong cash flows. Other winners to look for, I think you've got to suspect healthcare is going to be a very big sector now, very hot sector, given the fallout from the pandemic. I think that will be given a lasting boost. Could even be a bubble in certain expenditure. Best way to play that, always the picks and shovels approach. So those that are providing services to those at the coalface. So EMIS Group, with the leading software provider for GP centres. I think it looks good value around these sorts of levels. Tristel, as we've mentioned, the high-level disinfectant. I think there will be a lasting legacy for much more stringent cleaning within the hospital arena. Pharmacovigilance, or those that support the testing of drugs. So ErgoMed, I think, will be a long-term winner from that. It provides services, signing up patients, running the tests, and then monitoring the drugs when it's actually in the population. So picks and shovels is always a really, really good one. And also different winners in the sense of they may be losers at the moment, but look out for those companies that have been sold off aggressively that are still delivering very high levels of free cash flow. If the free cash flow yield, you can often see 10, 15, 20% free cash flow yields. So that's the free cash flow divided by the market cap. And that's great, especially if they've got debt. And it may seem contradicting myself because we do prefer net cash balance sheets, and our majority of the portfolio were net cash balance sheets, but there's a time and a place for everything. And debt is okay if it's used judiciously. As long as there's free cash flow, they can pay that debt burden down fairly rapidly. So you're going to get a repatriation from debt holders to equity holders in the enterprise value. And you'll probably get an upwards rating kicker as well, because that insolvency risk is being taken off the table as well. And then to generalize more so is the other winner should be small, cheap companies, as we've alluded to at the moment. This is a slide from great writer again, Ben Carlson, A Wealth of Common Sense. He writes daily. Some really, really fascinating insight. And these are the last two big market crashes that we have had, and it compares the experience thereafter from the lows of small cap value. So these are cheap small caps versus large caps. And the 3 and 5 year figures are annualized figures. So if we take 2002, over 1 year, they outperformed very strongly. And they still outperformed then 3 and 5 years very meaningfully as well. And that was repeated in 2009. You can see the bounce was even bigger, and that's because the fall was bigger going into it. And that tends to be what happens. The deeper, the faster the fall, the bigger the recovery, like an elastic band. And even there, over 3 and 5 years, small, cheap value outperformed. So there are areas I would urge listeners to spend at least some time thinking about and try and get in some exposure to.
So who do you think will be the losers?
Be careful of businesses that are okay for now. It's the opposite of delayed gratification, whatever that'd be, delayed denial maybe. It's okay because they furloughed the staff and have got agreements with landlords. But there's some business models that will hit a world of pain only later on when they get switched back on. And estate agents would be one, particularly if the kind of, the Americans say, mom and pop enterprises, They might own 3, 4, 5, 10 offices. And when these open, they're going to have to fund at least 3 months of costs before their first sales, before house sales come in and they get the commission. They're going to have to fund those 3 months. They probably could do it over 1 or 2 offices, but if you own a handful of them, they're just not going to be able or prepared to fund what will be a hugely significant outlay for them. So I think estate agents look okay for now because the government's paying the staff wages, but try and resurrect those businesses or take them off life support. So I think there's going to be a delay to certain business models that you're not going to see. Remember those fish rising to the surface, you're not going to see them for a while. There's going to be fewer agents around when we come out of this, and they're going to have fewer pounds to spend as well. So I think it's going to be a great opportunity for Property Franchise Group, who've got net cash on the balance sheet. But I think it could be terrible news for Rightmove, who really upset their customers. Well, they've been upsetting them for years by consistently increasing the price to charge to a level that really is squeezing the pips from them, to the extent that they've set up a website to say no to Rightmove. And this is the feedback I'm hearing from estate agents as well. Perhaps they've price gouged their customers too much. Good business models don't tend to be where you've got an adversarial relationship with your customer. So I'm not sure that the stock market is prepared yet or priced in that Rightmove's client base is not going to be anywhere near as big as it was pre-COVID. So I think that is one loser. I'd beware certain quality stocks as well, especially where the operating margins have risen over time as the sales have increased. That's operational gearing, and it is a good thing in good times, but the reverse happens as well. If your sales are falling, you've got fixed costs that you can't get rid of quickly enough, and it works against you. So the losses can be a lot bigger when you're starting to see revenues fall away. And some have added to the cost base recently, expecting a bigger business than they're going to have going forward. So weirdly, you might want to target companies that have shown consistent operating margin growth, because that may just be down towards the benefits of operational gearing. So look out for that. I'm watching the tech sector very closely as well. Facebook, Google, I think this is a picks and shovels shit. Talk about a picks and shovels trade. They've been huge beneficiaries of the largesse of venture capital. So the WeWorks, the Ubers, the Lyfts of this world, where customer acquisition generally comes from paying Google or Facebook for your adverts. That's how they're trying to get the customers. And there's been huge inflation in the costs of that. And that's why the profits of Facebook and Google is a large reason why they've been doing so well. And I think that tap's going to be turned off. And software as a service companies are great as long as your client base is strong enough to consistently pay you. I was listening to a good podcast in America. There was a leading dental software provider, and they've been getting inbounds from their customers saying, basically, we're not going to pay you now for 3 months, even though they've got a contract to pay them the regular earnings. They just said no, or we'll go to a different vendor, and they've had to swallow that. So people may be surprised at the very high quality, what they thought was very high quality recurring revenue software businesses might not be as strong as they thought. And would also be slightly cautious of the so-called compounding stocks, where they've got a high return on capital employed, and the theory is that they can take those very high levels of return and reinvest them incrementally at very high levels of return. These are what's called the compounding stocks. That's fine, but I think there's a lot of fake compounders out there as well. Share price since 2009 has been driven a lot by the PE going from 12, 13, 15 times up to 30 times. So I call these fake compounders. And as we can see, the Ferrari there, it isn't actually a Ferrari. It's a Toyota MR2 with a body kit of a Ferrari. And this is the way I it helps me to invest using kind of metaphors. It was very popular in the noughties to use the Toyota MR2, the Mark II edition for the aficionados out of there, and stick a Ferrari body kit. And I think there's a number of stocks that look like they're a compounder because the share price kept going up for 10 years, when in fact it's just been the re-rating, the PE. I don't think the actual business model dynamics would fit into the compounding one either.
So what are you looking for in companies, sort of culturally and operationally?
I always use the expression, character is destiny. And I do prefer founder-led businesses. The vast spine of the portfolio are family-owned. They're the ultimate problem solvers, call them what you want, intelligent fanatics, but they do generally are able to solve problems quicker. They're more nimble, there's more vitality about them. And they're entrepreneurial by design. They've retained that in their DNA. So I think they should have an advantage, a big advantage over large companies which are lumbering and with this committee, and it can almost be death by committee. You know, a camel is a horse designed by committee, so to speak. So I'm watching very closely that. I'm watching how they're treating the workers. I've got a working theory that those that are more engaged with their employees, and it can be something as simple as the CEO doing a Zoom chat every week or sending a daily memo around just to show them that they are in the trenches with the workforce, how well they're looking after their staff. It was no surprise to see Hollywood Bowl ensure that their staff will remain on full pay for as long as is practical, or RA International looking to do similar in third world countries, which is vitally important for them. And also I'm looking at how many of the board or senior management team are sharing the pain in this by reducing their salary by a percentage or for so many months. And sadly, the majority of companies are still seemingly paying themselves full whack. Only around a quarter of RNSs I've seen are the senior management team sharing in the pain and taking the 20% pay cut. I'm a big believer that what goes on inside a firm almost always trumps what goes on outside. If they're treating the workers well and they're treating the suppliers well, they're going to get all sorts of payback from that. That's going to last for years. We just don't see it that explicitly unless they're pointing it out to us, but it's something I'm carefully looking at.
Indeed. Do you think there'll be a credit squeeze? Everyone holding on to their cash, so severe cash flow pressure?
I think it was going to bring up the bulk of the economy down at one point, and this is the paradox where the worse something gets, the better it's going to get in terms of the outcome, because the government is going to have to throw the kitchen sink at it. So I think that pressure's gone now. I think the government guarantees on the loans and the furlough scheme has relieved or alleviated some of that. There will definitely still be some pressures building up at the company level. And I also think coming out of this, the consumer themselves have got to repair their own balance sheets, which could lead to a period of reduced consumption, or they may be scared that they didn't have enough savings going into this crisis, so they want to build up a savings buffer as well. So demand destruction can last for a number of years.
And what about M&A? Do you think that there'll be much more of it and survival of the fittest? And do you see it in any specific sector?
I do. And people are happy to fund it, as I say, which makes me a little bit nervous, because I would have preferred us to go through the despondency stage of investment where people almost hate equities, but it's still it's indicative that money is still relatively free and easy, and in some places it does make sense. A number of my corporates haven't been able to buy well because private equity has bid things up to levels that are going to deliver fairly mediocre returns to their private equity investors, and thankfully my company's been disciplined. So I'm hopeful if it lays private equity low for a period, we will see a revival. And these will be bolt-ons ideally, or arbitraging their own market cap rating relative to a private business, which should be on a lower multiple. So I do think you'll see M&A, survival of the fittest. I think, yes, I think we're seeing Darwinism on steroids at the moment. I'm amazed all the companies trying to claim they've got a strong balance sheet, just highlighting how much they can actually borrow. It's kind of akin to me going around with 10 credit cards and saying that's a vindication of how good a credit standing I have. So debt isn't the main issue, though. It depends on how the debt is structured, and also depends on the makeup of your assets. So look at companies where they may be asset heavy, but how quickly can they liquidate those assets? You know, a car dealer, its main assets are the building and the cars, but it's not going to be able to liquidate any of them very, very quickly. So the winners are going to be those with the strongest balance sheet, ideally net cash. Net cash makes you look like a hero in a downturn. It gives you options, and optionality, if it's a traded option, is worth a lot of money. That optionality, one, it means you're not going to go bust, likely go bust, and it means you have options your competitors simply don't, and you can take advantage of them. And there will be some distress selling. And we've mentioned Property Franchise Group. They are positioning themselves for this. Somewhat incredibly, the estate agent sector on the stock market all have pretty indebted balance sheets, except I think maybe Winkworth's the other exception. So they're looking at this, almost licking the lips on what they can pick up from what you would imagine very distressed sellers having to sell their managed tenant books, which deliver the lovely recurring revenues. And don't forget, people think it's very simple to switch a business back on. It absolutely isn't. It's like the fog of war's lifting. You've got to survey the damage, who the casualty are, who survived. That includes your suppliers. Some of them may no longer be there when you turn your business back on. And your workers, do you still need as many as you do? So just be careful about that. It's very, very hard to switch a business back on. As I say, the longer this goes on, there's going to be less businesses to switch back on.
So on the subject of how long it's going to go on to, we're going to open up to another poll and ask everyone what sort of recovery they think that we're going to have, whether it's going to be U-shape, V-shape, W-shape, L-shape, a letter that doesn't exist. So we'll leave people to fill that in. What's your views on the sort of recovery we'll have, Stephen?
Initially leaning towards a V. Just thought, because effectively turn the economy off and you can switch it back on again. But because it's going on longer than I initially thought, it's that destruction to capacity that's being taken out of the economy. Me personally, I think it's a letter that doesn't exist. It would be looks like a U with a slanty right arm, if that makes sense. Maybe a cross hybrid between a U and a V. That would be my working assumption at the moment. There's a lot of differences going on with this crisis that we're going through. I think a key difference for people to realise between 2009 and now is the furlough scheme, the government's furlough scheme is tremendous. It means that companies can avoid very expensive redundancies that came at the worst time for them. So they're not going to have as big a costs coming out of this. And you can also basically place them on the bench, and which means they can quickly bring them back into the business when it becomes a bit more business as usual, and not lose all of that knowledge and know-how and connections and relationship and experience, because it can take you months to rehire and you can miss out on a key initial stage of that recovery. And I think the Mission Group, who are a media company, they focus more on B2B rather than B2C. I think they will be a survivor and thrive in this environment. And I think that could make them more V than U-shape. For other, as we've said, you've got to be careful when they're coming out of the coma. You could easily see losses actually increase when they open for business. If you think in the shops and we're allowed to start to venture a little bit out into the environment, it will still be with social distancing likely. So they're going to have all the costs with a much lower revenue run rate. So you could actually start to see that delayed denial come through again, which would make it maybe even more of a W shape. So I think different companies are going to fit different letters. The key is how much of this destruction is permanent. Is the capacity of the economy going to get back to 90%, 95%, 80%? No one knows, but it is like a muscle and it atrophies. If you don't use it, if companies aren't trading every day, they will atrophy. And I say each day will be thousands more companies that simply don't make it.
Well, the result of the poll is fascinating in that 49% think that we're going to have a W shape and 30% think a U-shaped, and the others are marginal. So it's between a W and a U, I think. So structurally, what do you think is going to change as a result of COVID?
I think supply chains have been ruthlessly over-optimized. They're going to be re-engineered for resilience, not efficiency. So there's going to be onshoring, because there is a trade-off between optimization and robustness. So I think the onshoring trend that was already happening is just going to accelerate even more. That means more costs, because the reason they were so efficient, it was to reduce costs. So it is going to be more costly of the burden on the supply chain for companies, but it's going to be good for the domestic economy where those onshoring facilities are coming back. Pandemics typically favour labour over capital. That's a reverse of the situation we've had since 2009. But that alone would be more inflationary than we've been used to. So it's kind of Main Street over Wall Street, and that would point towards consumer discretionary, leisure, travel, durable goods. Structurally, maybe getting a good kicker that they haven't had. Pandemics also lead to lower real interest rates. So inflation higher than interest rates, which is exactly what the government want. So look out for that one. And I also suspect that efficient balance sheets will be out the window for a while as they figure out how to win that last war. I think they'll be carrying far less debt. Maybe you'll see politically, we always say buybacks are already getting politicised, and we can't keep going through these crises that require huge bailouts. And a lot of the balance sheet hollowing out was done to engage in financial engineering to do share buybacks, and maybe start thinking the unthinkable, that the interest rate tax shield should be taken away. Politics, we've seen that 2009 was still rippling into politics generally. We've had rise of the left and the far right, socialism generally. Everyone is sick to the back teeth of austerity. I think there'll be a regime change on the back of this as well. And cash, I think, could suffer. Cash has always been viewed as somewhat dirty, and shopkeepers used to have to worry about getting robbed. Now they're terrified of being given cash, given the current virus. And I think that'll change as well. And maybe we'll go to a cashless economy quicker, which is manna from heaven for the central banks, because they can monitor each and every transaction much more carefully. Less good, obviously, for the underworld, but maybe blockchain can finally find a place or a part to play in that. And to finish off on the lasting change, I just think fiscal policy is going to step up a lot more. And fiscal policy is real economy rather than the financial markets. And that fiscal generally is much more inflationary than monetary policy. So maybe all roads are starting to lead to value. Maybe this regime change may see value outperform growth, where it hasn't really happened since 2009.
And what about government monetary and fiscal policy to finance all of this, and especially, I suppose, business property relief for your IHT fund? Do you think, that's been threatened recently. Do you think that that's going to be threatened?
We were a little bit nervous. There was all sorts of people hamming up the risk that it would get repealed, and some accountants lobby. Don't know why it's upset them so much, but IHT wasn't even mentioned in the budget. And I think it'd be a little bit queer if the government removed it, and you're talking of billions of pounds of IHT money in AIM, which would simply have to go. What does that do to the cost of capital for those companies that remain? It would have to drive that cost of capital up. It'll mean expansion is more expensive. You want to do share placings, and maybe they don't grow as quickly. And we know SMEs are grist to the mill from a jobs creation point of view. And the taxes they pay in PAYE and national insurance and corporation tax are many, many, many multiples of the IHT tax that they miss out on. So never say never, but I would be hugely surprised. How all this is financed, I don't think we're going to see massive tax hikes. In World War I, the standard rate of tax actually went from 6% in 1914 to 30% in 1918. Very, very painful, but they had an inflation problem back then. But as I say, politically, austerity is dead. The masses are generally a bit fed up. I think we have to accept that government is going to be a lot bigger and more involved in our lives going forward than we used to. And I strongly suspect the fiscal profligacy will be funded by the printing presses. And in some ways, if your real interest rates are really, really low, you should be borrowing as much as possible. And as long as you can invest it in high return assets, maybe like roads and various other infrastructure, then that would be a good use of capital. But I don't know, I'm not very trusting that governments will be able to allocate the capital terribly well. And that's why we went through the rounds of privatisations that we did back in the day. You may have seen last month, the MPC said that they are thinking about funding the primary government bond market. At least QE had the fig leaf of credibility by buying bonds in the second-hand market. It was giving cash to a pension fund to buy some other asset, whereas this time it's just going to give the fund straight to the government. And it comes a point where helicopter money, modern monetary theory, call it what you want. But this is a Rubicon that we are crossing in very short order. And it's not only have we crossed the Rubicon on jet skis, but now rapidly tarmacking over the Rubicon, although it never existed in the first place. And if QE, I asked the question, if QE was always the answer, why haven't we been doing it and printing ourselves to prosperity for centuries? Why have we only woke up to it now? And there's a scary chart, which we'll show you now, which is the top 4 central banks. So ECB, the Fed, Japan, and the Bank of England. The central bank balance sheets as a percent of GDP actually started in 97. You can see that tick up there. And then as every crisis has got bigger, they've thrown more at it. They've encouraged a lot more moral hazard, which means the numbers get bigger again. And it just means that it becomes all too big to fail. I was fully expecting this to carry on because it reminds me of Nero, Emperor Nero, the denarius. They started to reduce the silver content of the denarius. And once you're on that road, this is classic path of least resistance. Who's going to be the central banker who comes in and say, this is utter nonsense. You're going to have to let capitalism work the way it does through creative destruction. But that would tip us into a depression for a period of time. But I'm just not sure where this ends and at what point do we start to resemble something like Zimbabwe. They tried this and it didn't work out terribly well for them. Is it 2 trillion? Is it 4 trillion? Is it 100 trillion? If you printed 1,000 trillion pounds, it would have to have some effect on the real economy and the price of money or the debasement of money or otherwise. So I think the lines are blurring very markedly between monetary and fiscal. Munskull, maybe we'll have to call it. It sounds a bit like numbskull, which is pretty apt. And we finish up with this chart. Maybe inflation is going to be part of the regime change going forward. The blue line, slightly complicated. This is the expected inflation rate in 5 years' time after 5 years. So in 5 years' time, what's the average inflation rate going to be for the next 5 years, in other words? And you can see it's very recently started to increase. And that's overlaid against the oil price. Normally, there's a fairly strong correlation between the two. Oil prices have laid low. Maybe this is the market starting to get a little bit concerned with this modern monetary theory, helicopter money, injecting cash directly into people's bank accounts, that the denouement to all of this is inflation. Caesar said when he crossed the Rubicon, let the die be cast, and the die has very much been cast, and quite where it ends, I am unsure, but it's certainly interesting times we live in.
That was very interesting, Stephen. We've got very little time, but I am going to open it up for questions from the webinar. Someone's referring to the last aspect about printing money, and they've said, hasn't this been working in Japan for 3 decades?
It depends what your definition of working is. I don't actually see Japan as being as big a failure as most economists would point out, because their GDP per capita is a better way to look at the Japanese economy, and it's actually been okay. Genie's out the bottle there, though. I forget what percent of the equity markets they own, but it is a prodigious amount. So they've started to buy not just bonds, but actual equities en masse. And at what point have you nationalised your entire stock market? It hasn't kickstarted growth in any meaningful way in inflation, but they really haven't engaged on the fiscal side as well. It has very much been at the monetary end, and it stayed within the monetary system. I just think we're looking much more at real economy impact, which affects the demand side of things much more than the supply side.
And another question, if inflation is likely, what types of stocks or investments work better?
Brilliant question. I've been thinking about it myself. And I always remember that something Warren Buffett said, actually, if you've got an inflationary environment, you want to target asset-light companies. And that's very much at the forefront of my mind. He didn't like companies where the company owner would show him around the work floor and show all his machines that he's bought with his profits. There are his profits. He didn't like that at all. He likes asset-light companies, and that's contrary to what you'd expect. If you think inflation is going to be quite high, generally you want to own assets and hard assets. things like buildings. Problem for asset intense companies, that capital needs to be replenished regularly. And if that cost of that machine then is going up more than your revenues are going up, it becomes very capital consumptive. So people, if they do buy into this inflationary story, the bulk of your portfolio really should be in asset-light companies.
Do you have a view on the house building sector?
We owned them I think we bought them originally 2010 and then sold them 2014, something like 2015, sold them far too quickly. I think the government's one of the stupidest policies I've seen in a long time was Help to Buy. Hopefully it does get repealed when they say it will. I suspect it'll be kept on for a couple more years now, given what's gone on. I just got an issue with house builders making operating margins akin to a software company. You find a bit of land and you throw some bricks up on it to grossly simplify, but they're not reinventing the wheel here. I just think it's become far too cozy, and there's a distinct lack of competition. In the 90s, we had a proliferation of small builders, and they've been taken out of the market, and banks, a lot of banks just are not happy to get involved in construction anymore. So I've never used the word cartel, but it certainly seems too cozy and they seem too powerful. And Help to Buy has been a failure for the people who've taken advantage of it as well. Unfortunately, they're realising they're not building any equity up to move up to the next rung of the ladder now.
Thank you very much, Stephen. I'm afraid that's all we've got time for, but tell people where they can find you.
On LinkedIn or our website, Blankstone Sington, and my email and telephone number will be there.
Thank you very much, Stephen. It's been a great webinar. So for everyone listening, sorry, Stephen, thank you. If you want an email notification of events or webinars we're organising, please do the sign up for events on the right-hand side of the homepage at PIWORLD. I think there's 2 boxes, one to subscribe and one to sign up for events. So sign up there and we don't spam anyone. And lastly, please do tell your investing friends about PIWORLD and write comments or like our videos on Twitter and bulletin boards and YouTube. We'd like to go on providing these free webinars and getting good speakers, and they rely on getting good audience numbers. So thanks very much for joining us and stay well.